Okay, so let us move to next concept, dividend decisions. In fact, this dividend decision was earlier in the old syllabus SFM, now moved to intermediate. So from your final SFM point of view, this is not so much relevant as far as the full-fledged problems are concerned. But the concepts, the applications are still relevant in so many places, so we have to cover these topics. So our application part of will be limited. We will not be doing too much in-depth problems because that's not really part of your syllabus. But as a concept, you should be aware of it for its application purpose. So we are reading it. Okay, if I ask you one basic question, do you like a company who pay dividend or you don't like a company who pay dividends? You can argue in two ways. I'll come to that. First of all, let me ask you, what is dividend? Of course, you can't give Companies Act definition. Companies Act definition is dividend includes interim dividend. We can't have that definition. What is dividend? It is distribution of profits. Profits you earn, you distribute among shareholders. That's called as dividend. Now, can I say it is very similar to in a partnership firm, profits will be there belonging to partner and he take the profits, he withdraw the share of profit. It is same, right? Effectively. Yes, controlling aspect is different because in the company board of directors will decide, but in a partnership firm the partner can withdraw, of course, with the consent of other partners. But ultimately, effect is the money will flow from the company, the firm, to the individual investor, partner, or shareholder. So, if you look at the structure, you will have company in between, the shareholder gives money, he invests, and company will invest in various projects. They do business, they do projects, or they do business. And whatever the money they get, that's what is profits. And when those profits are distributed among shareholders, that is what is called as dividends. Distributed profits is called as dividends. Okay. Just like a partner withdrawing share of profit from the partnership firm. Okay, now let me ask you one basic question. When company pay dividend, what will happen to the share price of the company on dividend payments? What will happen to share price? Immediate impact. I'm asking about immediate impact. Do you think the share price increase or do you think share price decrease or do you think share price remains same? No increase, no decrease. What do you think? When a company makes dividend payment, what will happen to share price immediately? The immediate impact is negative. The moment company makes the payment, immediate impact I'm asking or immediate impact on price is negative. The share price will come down. For simplicity's sake, you imagine share price represents net worth of a company. Assume net book value is equal to share price for simplicity's sake. Other things remaining constant. Now, when company makes the payment of dividend, what will happen to their net worth? You pay out cash, right? cash will go out. So net worth of a company will come down, or you can say net worth is the share capital plus reserves. When you distribute profits, reserves will come down, net worth will come down. And I was just telling, it is very similar to partner withdrawing his share of profits. Now, if partner withdraw his share of profits, his capital account, what will happen? Partner's capital account will come down. That means partner's investment in capital or his recovery amount will come down, because if investment is 1 lakh, he received 10,000, his receivable only remaining 90,000. Keeping it all aside, distribution of profits will reduce net worth of a company, so immediate impact is always negative, and it's also called as ex dividend price. Immediately when the share price is paid, that's called as ex dividend price. So other things remaining constant, when company pay dividends, the share price will fall, and that price is called as ex dividend price. Don't think about your X. X means excluding. Other things remaining same. But market price will also fluctuate for other reasons. So practically it may be difficult for you to observe this impact. And also, it happened couple of months back. There's one company called as Majesco. They paid huge dividend, like 900%, 1000%. So share price fell dramatically. Many people purchase the share thinking you get good dividend. Yes, you will get good dividend. Share price will fall down. Ultimately, net worth of the company will remain same. You also have concept of pre-acquisition dividend in accounts, dividend out of pre-acquisition profits, and also you have what do you call dividend stripping in income tax, which is adjusted against the cost of acquisition and not treated as income from other source. Anyway, I don't want to mix so much, so please write down. Let's write down quickly. Dividend means distribution of profit, meaning distribution of profits. Immediate impact on price. Impact on price. Immediate impact. Okay, this is immediate impact. Immediate impact on price, that is negative. Other things remaining same. Immediate impact. So when company pay dividends, share price will fall. Other things remaining same, of course. Share price will fall, and called as ex dividend price. In your Companies Act also you have record date, X date, declaration date, right? When the payment is made, the share price will fall, because it's a distribution of profits, it's a distribution of net worth, cash outflow. But what is happening on value, impact on value in long term? Now this is talking about dividend policy of a company. If company pay regular dividend, is that good? Or company don't pay regular dividend, is that good? That is a matter of subjectivity. You can argue on both sides. One argument, company pay regular dividend, that must be company must be very profitable, so it is a dependent company. While choosing companies, I've seen various investor Rakesh Jhunjhunwala and others One of the criteria they look at is dividend. Are they paying regular dividend? If they are paying regular dividend, it's a good profitable company. We can have confidence. But you can argue another way. Why is that? You are getting money from your business. Instead of paying back to shareholder, why don't you reinvest in the business and let the business grow? You can venture into new sectors. You can have new branches. You can expand the capacity. So you are repaying back the dividend means you don't know how to grow the business even more high. You don't have that capacity to increase the sales. So you are paying the money back to shareholders. That is also a valid argument. Company like Infosys, they pay regular dividend. At least 3-4 times they pay dividend, Infosys. And they are only into IT sector. Reliance, they pay hardly any dividends. They are into every sector. They believe in reinvestment. In Reliance Jio, they could give so much of free offers. But where could they get the cash support? The money earned from other business. They have not paid the dividend back to shareholders. They have reinvested in new ventures and the business grow in various sectors. I'm not telling Infosys is good or I'm not telling Reliance is good. I'm just telling you two different points of view. So on value in the long term, we have different dividend theories. On the long term, we have different dividend theories. Dividend theories. And they give conflicting answer. They give subjective opinions. Different people will tell differently. Some people will tell it will increase, some people will it is not good, some people tell it does not affect on the value in the long term sentiment. But in the short term, immediate impact, please take it very strongly to your head. The price will fall on the date of dividend payment. But the value, the brand, the confidence of the company in the market, different people view it differently. Hope you have taken on this chart. Now let me quickly go through the dividend theories. So many are there. I will discuss what is relevant from exam point of view. Okay, so let me talk about dividend theories now. Dividend theories, yeah, quickly. And I hope you know basic terminologies. D0 means dividend today or just paid. D1 means dividend expected to be paid. Payout ratio is DPS by EPS. Remaining amount is called as retention ratio, 1 minus payout ratio, or EPS minus DPS, retained earnings by EPS. Dividend yield, DPS by market price into 100. I hope you are aware of those aspects. Basic terminologies. Anyway, when we do the problems, those things will come in that process. Okay, let me take up now dividend theories, at least relevant from our exam point of view. Dividend theories. Broadly, I would say there are four. We have Walter model, we have Gordon growth model, or also called as constant growth. Then we have variable growth, dividend variable growth, and we have M&M, Modigliani and Miller approach. Among them, this Gordon growth model and variable growth model are even more very important. Or even more very important for the reason we will be applying it in cash flow model, FCFF, FCFE. There also we will be using it for that reason. Okay, let me quickly tell you the Walter model. The formula he gives, he divides the formula into two parts. And he follow earnings capitalization approach. What is earning capitalization? Numerator earnings, denominator required rate of return, capitalization or cost of capital. And earnings he divides into two parts: distributed profits, undistributed profits. Distributed profits, dividend; undistributed profits, retained earnings. Now, distributed profits, will it grow? It will not grow because you paid to the shareholder, gone case. Nothing growth after that. But retained earnings means reinvestment in the business, and reinvestment in the business that can generate even more profits. So that value he is going to take it as a separate factor. So formula, he says P0, price, theoretical price, okay. There is no one formula for price calculation. For price calculation, I will say value determination. These are all theoretical price. Value in their opinion. That is given by two parts I told you. DPS, distributed profits, dividend, plus retained earnings, EPS minus DPS. Now EPS minus DPS, retained earnings. Now this will grow based on where company reinvest. Reinvestment rate is called as RA. RA stands for return on assets. Return generated by the company by investing in the projects. And this value we divide by RC, return on capital, cost of capital, cost of equity, that is the expectation of the shareholder. So what is RA RC difference means? RA means when company invest, how much they expect. RC means shareholder. Now shareholder gives the money to company, company invest in projects. What company is generating from the project is called as RA, return on asset. You can also say ROE, return on equity, what company is generating. What is RC? The cost of capital, the shareholders expecting from the company. Shareholders expectation is company's cost. Your expectation, my cost. What is shareholder expecting is cost of capital, RC. This is the value of retained earnings. And total, this will come every year. So we divide by RC, return on capital. RE, return on asset. RC, return on capital. You can also say cost of capital. And he recommends two important aspects. If RA is more than RC, means RA is more, company is able to generate more, then payout ratio, he recommends, okay, optimum payout ratio. Optimum payout, according to him, optimum payouts, if RA is more than RC, then he recommends it should be 0%. Because when you have more capacity to generate more return than what shareholder expects, money should be with you. Don't give it to them. 0% payout. Whereas if RA is less than RC, then he recommends you are not meeting shareholder expectation. Give back everything to them. The payout ratio is 100%. That is Walter model. His opinion, of course. Gordon growth model, the formula is given by P0, that is his opinion. P0, price today, is D1 or D0 into 1 plus G. D0 dividend just paid into 1 plus growth rate divided by KE minus G. KE cost of equity, G for growth rate. And sometimes they will not give you growth rate. So growth rate is B into R. B for retention ratio and R is return on investment by company. That RA, what I told you, return on asset for the company when they invest in the project, that is what this ROI, return on investment by the company. Formula derivation I would like to give you, but let me complete this, then I'll go for the derivation aspect. Variable growth model, we follow two-step approach. We calculate terminal value, then we calculate present value. So two-step approach, we calculate terminal value and then we calculate present value. I'll explain that process along with that logic. But just write down TV, we calculate the terminal value first. We calculate terminal value and then we calculate present value. Two-step approach, variable growth model. M&M is dividend irrelevant theory. Irrelevant theory means he says does not matter. This person was there in capital structure theory also, if you remember your past life, IPCC, where we're discussing taking money, good for business, bad for business. People are arguing net income approach, net operating income approach, something good, something bad. And M&M, Modigliani and Miller, not Modigliani, Modigliani and Miller came and told, does not matter whether you take debt or you don't take debt, value of the company remains same. Whether you take dividend, whether you pay dividend or you don't pay dividend, value of company remains same. You also follow something called as arbitrage approach. Anyway, that is more part of your intermediate syllabus. Just remember, M&M is dividend irrelevance theory. This is, imagine situation like this. There one person sitting over there and you go and tell him, why are you wasting your time? Why don't you do CA and achieve something in life? He tells, why should I do CA? You tell, you can do articleship. After that, you can write exams. After that, you can write many exams. In CA, you write exam after exams. And after that, you can pass exams, you can become CA. After that, you can have job. After that, you can have a good family. You can have a peaceful life. Other person says, I'm having a peaceful life now itself. Why should I do all this circus? Don't take the example wrongly. You already started the CA exams. Now you can't go back. Just to make you understand the concept, I am telling you this. He's telling that same aspect. If you pay dividend, your resources will come down. For your new projects, you have to raise the resource. So you are going to issue more shares to raise the money. If you don't pay dividend, you will have the resource with yourself. You will have to issue less number of shares because you are already having the money for investment purpose. Anyway, so these things, when we do a problem numerically, you'll understand better. But let me give a derivation for this Gordon growth model and variable growth model. As far as CA final is concerned, these two are even more important. I hope you have taken the summary part. I'm going to give you derivation for the Gordon growth and it's connected with variable growth. And this derivation what we're using is not only used for dividend growth, it can be used for any cash flow growing at a constant rate. Anyway, first you please take it down and let me know if you have any question. Then I'll give derivation for these two, which is important. Okay, hope you have done. I'll go further. Okay, Gordon growth, let me give little bit detail. Gordon growth formula. Gordon model. Dividends growing at a consistent rate. Dividends growing at a constant rate. Now, what is our basic definition of an asset? Present value of future cash flows, right? Basic definition of an asset. Any value of asset in financial management is present value of future cash flows. Now it comes to value of shares. What cash flow you get? Dividend, right? So you have year 0, dividend 1, year 1, dividend 2, year 2, dividend 3, and so on forever, infinity. Because company is perpetual, infinity, forever. Dot, 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 dot. Now, if I discount this, these are future cash flows. If I discount this like this every year, dot, 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 dot for every year, that present value is value of share. You can say intrinsic value. This present value is value of share, share value or intrinsic value. This is basic concept. Okay, now this D1, let's say these dividends are growing at a constant rate now. Now, if I say growing at a constant rate, it compounds like salary, like inflation, like interest. So, how do you calculate year 1 dividend? Can I write like this? D0 into 1 plus G, growing. D0 into 1 plus G, growth by 1 growth. Second year, again 1 plus G, multiplicative model. So what will be second year dividend? D2 will be D0 into 1 plus G whole square, right? D1 will be D0 into 1 plus G. D2 will be D0 into 1 plus G square. Similarly, D3 will be D0 into 1 plus G to the power of 3. D1, D2, D3. But this will be present value. Now present value, how do we calculate? We divide by 1 plus KE or 1 plus R. KE, required rate of return, cost of equity. This is 1 year discounting rate. Second year, what do I do? Divide by 1 plus KE whole square divided by 1 plus KE to the power of 3 dot 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 plus P0, or you can say intrinsic value, value of the share equals first year dividend, present value, second year dividend, present value, third year dividend, present value, like that dot 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 forever, dividend forever, infinity. And discount it 1 by 1 plus k, 1 by 1 plus k whole square, 1 by 1 plus k whole cube, and so on. Now, if you see this pattern, this actually follows geometric progression. What is geometric progression? You observe D0 like this. What is this term? 1 plus G by 1 plus KE. Next, what happened? 1 plus G square, 1 plus KE square. So, both terms are multiplied. Now, again you multiply by 1 plus G by 1 plus K. It becomes Q. Basically, this follows geometric progression pattern. Sum up to infinite series. In geometric, we have formula A by 1 minus R. You don't worry about it. I'm not going to show that. But if you want, if you're interested in mathematics, you can go and check it out. Geometric series, sum up to infinite terms. After simplifying, you get the formula P0 equals D0 into 1 plus G by K minus G, or you can write down D1 by Ke minus G. The reason why I had to show you this derivation, because many people will have a misconception, misunderstanding. When I give you formula directly, D1 by K minus G, or some people ask me this doubt. Why are we taking only first year dividend, D1 only? Why? Why not D2, D3? If you look at the derivation, you understand. I am not only considering D1, D2, D3, I am considering dividend forever. But when I simplify that mathematically, it looks I am considering only first year dividend, but it is involving dividend forever. Formula appears to be 1 year dividend, but simplification, you should understand, it involves dividend forever. I hope you're able to understand the application side of Gordon growth model, or what is the implicit interpretation in this formula. Now here, what I told you for dividend, it can be for any asset, any cash flow, as long as cash flow is growing at a constant rate. So any cash flow growing at a constant rate, this is also called as constant growth model. Gordon model can be applied. And you are having not only first year dividend, you are having dividend forever. Okay, one more small logical aspect I will tell you. See if you can understand and remember it. Look at what calculations happening. I am multiplying by 1 plus g, 1 plus g square, 1 plus g cube, and dividing by 1 plus k, 1 plus k, 1 plus k. Are you understanding mathematically? Compounding by growth rate, discounting by cost of equity. When I multiply, I am compounding. When I divide, I am discounting. So I am multiplying by one, discounting by another. So I am going to calculate net rates. In the sense, I am compounding by 8%. I am discounting by 10%. So net discount, can I say 2%? Are you understanding? I'm going up, I'm compounding at 8%, multiplying, and I'm dividing. I'm coming back, discounting by 10%. Effectively discount 2%. That's what K minus G, 10% minus 8%. Anyway, that's one of the way of remembering the formula. 1 plus G, 1 plus G, 1 plus G, I'm compounding. Divide by 1 plus K, divide by 1 plus K, discounting. So effectively, I take the net rate. And this dividend includes dividend forever. This formula can be applied for any cash flow growing at a constant rate. Only problem I see with this formula is, dividend formula is, if company does not pay dividend, it looks like company share price becomes zero. That's one of the problem. Or if cost of equity is more than growth rate, then that's also going to be a problem, because you get a negative answer. You cannot have a negative answer for the company's share price. Limited liability concept. Anyway, so you write down here, based on this, I'm going to extend this towards variable growth model. Okay, I hope you have taken down till here. Okay. Okay, now let me ask you this. This P0 considers D1 onwards, meaning when I do D1 by K minus G, I get P0. Now, can you tell me, if I do D3 by K minus G, can you tell me what P I get? Or let me say I'll say D5. I will ask you once more. When I used D1 by Ke minus G, I got P0. D1, I got P0. If I make it D5 by Ke minus G, what P I get price? Using D1, I got P0. Using D5, I will get P4, right? One term less. D1, 1 became 0 at the beginning. Similarly, D5, I'll get beginning of D5, or that is nothing but P4. P4. I'll ask you once more, see if you are able to do. Suppose if I do D10 by K minus G, what price I get? Price I get is P9. Right? So let me do one thing. Once you write this, please write some observations. Let us write down that aspect. Okay, write down observations. P0 reflects. P0 reflects. P0 reflects the value of dividend. P0 reflects the value of dividend from year 1 onwards. P0 reflects the value of year 1 dividend onwards. Year 1 dividend onwards. Year 1 dividend onwards. Similarly, P4 represents dividend from. Can you tell me which year onwards you will take it? P4, I am investing at the end of year 4. When will I get dividend? 1 year later, right? Immediately I don't get dividends. So P4 represents the value of dividend from year 5 onwards. Value of dividend from year 5 onwards. Value of dividend from year 5 onwards. Hence, P4 equals D5 by Ke minus G. So basically you remember there will always be 1 year less. 1 term less. Because if I invest now, I get cash flow after 1 year. I don't get the cash flow immediately. I don't get the dividend immediately. So it will always be 1 year less or 1 term less. When I use D5, I'll get P4. Okay, why I'm telling you this? I'm going to teach you this variable growth model. But before that, any doubt till here? Okay. Let me come to now variable growth model. Okay, what is variable growth model? Example, let's say year 1, the dividend will grow at 8%. Year 2, dividend will grow at 8%. Year 3, dividend will grow at 9%. Year 4, dividend will grow at 9%. Year 5 onwards, dividend will grow at 10%. Year 5, year 6, year 7, you will have 10%. So dividend is not growing at one single rate, dividend is growing at different rates, growth rate. Variable growth model. Now I cannot use the formula D1 by K minus G, we have multiple growth rates. but growth rate becoming constant after a particular point in time. This is important. So you can see here dividend growth becoming constant. Dividends or growth became constant. So what is this Gordon growth model? You can apply if the dividend growth is constant. Okay, now this will be, if I represent in dividend, this will be D1, D2, D3, D4, D5, D6, D7, dot dot dot. Here I cannot use the Gordon growth model because from year 1 only, from the starting point, growth rate is not same. But growth rate is becoming constant. From which year? From 5th year onwards, growth rate becoming constant. Now when growth rate becomes constant, I can calculate or I can apply Gordon model. Now we have just learned the formula as well. When I use the Gordon model, not at the beginning, but using D5, D6, D7 onwards, if I do present value of these things, dot 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 forever, okay, dot 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 forever. Now can you tell me what do you call the price when I consider the value of D5 forever? What price represents D5 onwards? D5, D6, D7 onwards. That price is called as P4, isn't it? D5, D6, D7, if I do present value, D5 by K minus G, I just told you one term less. So when I discount this D5, when I discount this D6, when I discount this D7, what I get now, and then dot dot dot, okay, dot dot dot. What I get here is, you can say P4, sorry, P4, P4, that is D5 by K minus G. Here I can apply the formula because growth rate is constant, Gordon growth model can be applied. But I need P0, I need today value. What should I do? From the P4, I bring it back to P0. 4 year I'll come back. But one problem is there. What is it? One problem. This considers only dividend 5 year onwards. You can see in the graph, you can see in the PPT. It considers only D5 onwards dividends. But what about D1, D2, D3, D4? That is not included in P4. Therefore, those things have to be discounted separately. D1, D2, D3, D4. Then you can do sum of all these things. That sum total is what you get. Intrinsic value IV, or you can say P0. This is what you called where growth rate becoming constant. That is what is also called as terminal value. So if you understand, it is a step down approach. D5, D6, D7 onwards forever, we discount it to P4. From P4, we come to P0. Step down approach. D5 to P4, D6 to P4, D7 to P4. And from P4, we are coming to P0. Step down approach. But P4 does not include D1, D2, D3, D4. Therefore, those things also should be discounted. This is visual representation. In examination, we follow tabulation approach. Tabulation, you know, we will write year, cash flow, discounting factor, discounted cash flow. Here what we'll write year 1, 2, 3, 4, 5 onwards. Right? 1, 2, 3, 4 we are having different growth rates. 5 onwards same growth rate. So cash flow will be, this will be D1, D2, D3. Okay, I don't have space here. I'll write in the next slide. But make sure you have written this here till here. I'll give you 2 minutes. Then I will write the tabulation format, the same thing. Or I'll see if I can fit in here. Year, cash flow, discounting factor, discounted cash flow. Year 1, 2, 3, 4, 5 onwards. Cash flow year 1 we will take D1, year 2 will have D2, year 3 will have D3, year 4 will have D4, year 5 onwards I don't do D5, I'll do D5 by K minus G, means I will get TV4. D5 I'll use, means D5 onwards, so I'll get a TV4, or you can say P4. Then when I discount it, discounting factor, then you calculate all this present value. The total present value is P0, or you can also say IV0, intrinsic value, or you can say P0. Intrinsic, what is included, implicit. And one small point, this last year D4 and TV4 will have same cash flow. D4 and this P4 will be at same point in time, will have same cash flow. Some people will write discounting factor in a flow, or discounting factor of year 1, year 2, year 3, year 4, year 5. No, last one also discounting factor of year 4. Remember that. Just like bond, last year in the bond you will have a coupon and you will have redemption price. Both will have same discounting factor, just like that. Last year dividend you will have, last year terminal value also you will have. So last two cash flows will have same discounting factor. So write down the visual representation as well as the tabular representation. Now this concept we can apply not only for the dividends, for any cash flow growing at a variable rate, and after a particular point the growth rate become constant. So this concept we will be using it in FCFF model as well as FCFE model. Okay, so please let me know once it is done. Okay, very good. So hope you got it. Let's go further to problems.